Good morning, my dear students. Hope you are doing well. So, I am here and before you with a new video, that is income tax amendments applicable to May 2025 and September 2025 and January 2026 for CA inter attempt. Okay. So, my dear students, without wasting the time, come to the point directly. This time, so many of amendments are there in income tax subject. So, in various chapters, I'll explain each and every amendment in chapter wise. Okay, coming to the point. Okay, income tax amendments as per Finance Act 2024 applicable to May, September 2025 as well as January 2026 for CA Inter. Okay, so coming to the point directly, basic concepts. In first chapter, we have two amendments. So first amendment is very important. This is the first amendment, that is in section 115 BAC. 115 BAC slab rates were changed in Finance Act 2024. These are the new slab rates applicable in section 115 BAC. This is the amended area. These are the old rates. Okay. So instead of old rates, you have to apply new slab rates under section 115 BAC. Please be concentrate. This is very important amendment this time in introduction chapter. Up to 3 lakhs, no need to pay any tax. 3 lakhs to 7 lakhs, rate is 5%. 7 lakhs to 10 lakhs, rate is 10%. 10 to 12 lakhs, rate is 15%. 12 to 15 lakhs, rate is 20%. Above 15 lakhs, 30%. So these are the new slab rates applicable in section 115 BAC, which is very important amendment in this chapter. Okay, and simple amendment also you can prepare easily. And the second amendment in this chapter is foreign company tax rate. Yes, earlier it was 40%, now it was reduced to only 35%. My dear students, two amendments are there in introduction chapter. These two amendments are favorable to the assessee. Okay, assessee point of view, these two amendments are very favorable amendments. So these amendments, due to these amendments, assessee point of view, so some amount of tax savings is there. Okay, so favorable amendments to the assessee. Okay, my dear students, foreign company tax rate was changed. Earlier it was 40%, now it was decreased to 35%. And 115 BAC tax rates, slab rates were changed. And out of these two amendments, please be concentrate more on 115 BAC slab rates, most important. Okay, in this chapter, the first amendment is the most important amendment. Next, come to the next chapter, salary set. My dear students, so in this chapter, we have only one amendment, which is very important amendment. We have to concentrate more, most important amendment. Only one amendment, but most important amendment this time in exam point of view also. Okay, so what is the amendment? Two simple amendment here is standard deduction. My dear student, there are three deductions from gross salary in salary set: standard deduction, entertainment allowance, and professional tax. Out of that, first deduction is standard deduction. We have an amendment in standard deduction area. My dear students, before amendment, we have a standard deduction of 50,000 in both default tax regime as well as optional tax regime. For both default as well as optional, standard deduction is 50,000. But now the amendment is under default tax regime, the deduction was increased to 75,000 from 50,000. This is the amendment, 75,000. This is the amended area. In optional tax regime, no change, still 50,000 as it is. The change is only in default tax regime, and the deduction increased to 75,000 from 50,000. Have you understood? Simple amendment. Before amendment, we have 50,000 deduction in both default as well as optional tax regime. After amendment, So that the deduction under default tax regime was increased to 75,000 from 50,000. In optional tax regime, no change. Till 50,000 will continue. Okay. So simple amendment. You have to concentrate more. Compulsory. You can find a salary problem in your exam point of view. Whenever you solve the salary problem, compulsory you need to apply this deduction. It's a mandatory deduction from salary income. Okay. Please be concentrate. Very important amendment. So this chapter, in salaries chapter, we have only one amendment, which is very important. In introduction chapter, we have two amendments. Out of that, first amendment is most important when compared to second one. Okay. So next, third, coming to the point, PGBP. PGBP, my dear students. So in this chapter, we can identify two amendments. One in section 36, subsection 1, another one in 40B. Okay, two changes in PGBP chapter, and two amendments are very important in exam point of view. Okay, so first amendment in section 36, subsection 1. First amendment, section 36, subsection 1, which is important amendment. What this amendment is nothing but, my dear student, in section 36, subsection 1, it's an expenditure section. So what this section says that out of so many of expenses are there in this section, 36 subsection 1. Out of that, so one of the expenditure is employer's contribution to 80 CCD pension plan. Is nothing but NPS, Notified Pension Scheme of the central government. That contribution will be allowed as deduction to employer. I'll explain. Employer contribution. Section 36, subsection. The amendment in section 36, subsection 1. Employer contribution. Employer contribution to NPS under section 80 CCD. Notified pension scheme referred to in section 80 CCD. Employer contribution to NPS. No doubt, this will be treated as an expenditure to employer. Employer point of view, this contribution is to be claimed as a business expenditure under section 36, subsection 1. But the amendment is, there is a restriction. There is a restriction to claim this expenditure under the head PGBP in the hands of employer. Earlier, the restriction is maximum deduction can't claim more than 10% of salary as an expenditure. Now it was increased to 14% of salary, up to 14% of salary. That should be the amendment in this area. Earlier, expenditure to the employer, but allowed as deduction. Allowed as deduction up to 10% of salary. Earlier. Okay, this is the limit applicable for this expenditure to claim under the head PGBP in the hands of employer. Earlier, it was allowed as deduction up to 10% of salary. Okay, but now after amendment, allowed as deduction up to 14% of salary. This is the amended area. Okay, this is also a favorable amendment to the assessee. Assessee can claim higher deduction. Earlier, it was maximum deduction cannot exceed 10% of salary, but now it was increased to 14% of salary. The employer can claim up to 14% of salary now after amendment. This is the amended area. Have you understood? 36 subsection 1. This is very important amendment, may be useful for MCQ also. Please be concentrate on this amendment. Okay. So increased from 10% to 14%. This is the amended area. Deduction under the head PGBP under section 36 subsection 1. Okay, next one. Second amendment, 40B, assessment of partnership form. This one is also very important and some extent difficult amendment also. So 40B, assessment of partnership forms. This section is relating to firm related section. So this is the firm related section, and what this section says that generally whatever the interest and remuneration payable to partners will be allowed as deduction to partnership firm, subject to some conditions and some limits. Okay, so in those conditions there is an amendment here. Okay, so I'll explain this amendment, what the amendment exactly made. So 40B amendment, what the amendment says that, so partnership firm paid any remuneration to working partners. Partnership firm paid any remuneration to working partners. This remuneration is treated as expenditure to the firm. Firm point of view, that will be treated as an expenditure, but subject to some limit. Expenditure allowed subject to some conditions and limits. Allowed subject to some limits, some conditions and limits. Okay, so remuneration paid to working partners by partnership firm to be claimed as a deduction under the head PGBP in the books of partnership firm, subject to some conditions as well as limits. So there is an amendment in limit. Earlier the limit is different, now the limit was changed. Here also this amendment is also favorable amendment to the assessee. Assessee point of view, it's a favorable amendment. Okay, I'll explain. What is the new limit applicable? The limit applicable, limit is equal to one of the important point. What is the limit applicable for remuneration payable to working partners in the hands of partnership firm? The limit is first calculate the book profit. And so I'll explain with a practical example. For example, firm book profit is 10 lakhs rupees. I don't want to explain how to calculate book profit. There is no change in that. Please go and verify in your material. But book profit calculation is there. So first calculate the book profit. For example, let us take an example. Book profit 10 lakhs rupees. Book profit 10 lakhs rupees. But what the act says that this book profit shall be classified into two parts. First 6 lakhs, balance 4 lakhs. First 6 lakhs of the book profit, balance book profit to be considered separately. Okay, so on first 6 lakhs of the book profit, what the calculation we have to use here is 90% of book profit is nothing but 90% of 6 lakhs or 3 lakhs, whichever is higher to be considered. That is 90% of 6 lakhs is equal to 5.4 lakhs or 3 lakhs, whichever is higher, that equal to 5.4 lakhs. Have you understood? On balance book profit, you have to apply 60%, 4 lakhs into 60%, 2.4 lakhs. In aggregate, 7.8 lakhs. That is the limit. Okay, this is the amended limits. Okay, so limit is maximum 7,80,000. That is, if firm book profit is 10 lakhs, maximum permissible remuneration is 7.8 lakhs. Okay, that is, for example, if firm paid 8 lakhs remuneration actually to the partners, then 7,80,000 is only eligible for deduction. Balance 20,000 will not be allowed as deduction. If firm paid only 7 lakhs actual remuneration to the partner, then entire 7 lakhs to be claimed as deduction, because that is within the limits. That is actual payment or limit, whichever is lower is the allowable remuneration. Balance, if any, shall be disallowed. That should be the amended area. Okay, so this is the amended provision in this section 40B. But what was the old provision? Earlier it was instead of 6 lakhs, we have to use 3 lakhs only. Instead of 3 lakhs, we have to use 1.5 lakhs. Exactly the amounts were doubled. Instead of 1.5 lakhs, now we have to use 3 lakhs. Instead of 3 lakhs, we have to use 6 lakhs. That should be the amendment. Okay, so that should be the point. Please verify the amendment. Here is, this is the before amendment table, old table. Now this is the new table. In old table, in first 3 lakhs, 1.5 lakhs or 90% of book profit, whichever is higher. On balance book profit, 60%. Now the limits were changed as on first 6 lakhs, 3 lakhs or 90% of book profit, whichever is higher. On balance book profit, 6 lakhs, 60%. And of course, in case of book loss, maximum limit is earlier 1.5, now 3 lakhs. This is also an amended area. In case of book loss, permissible remuneration is up to 3 lakhs. Earlier it was 1.5 lakhs. In case of book profit, we have to separate it as first 6 lakhs and balance book profit. For first 6 lakhs, 90% or 3 lakhs, whichever is higher, balance book profit 60% to be considered. So this is the amended area, which is very important amendment this time in PGBP. Okay, so now you need not prepare this table. Instead of that, you have to prepare this table. Have you understood? So my dear students, this time PGBP head having 2 important amendments. All 2 amendments are very important in exam point of view. Please be concentrate more. Out of these 2, please be concentrate more on the second amendment, because this is some extent complicated amendment in this chapter. Have you understood? Next, coming to the next chapter, capital gain. My dear students, so this time this chapter is having lot of amendments, 4 amendments, and all those amendments are very important. Compulsory, we will expect 1 question from this chapter from amended areas. Compulsory. Don't neglect. You will prepare every amendment involved in capital gain chapter mandatorily. Okay. So many of areas are there. Like for example, period of holding area. There is an amendment in period of holding. There is an amendment in 50AA section. There is an amendment in indexation facility. There is an amendment in 112, 111A, 112A. In all these areas, and 46A buyback is also there. Around 5 to 6 amendments are there in this chapter. So, so that you have to concentrate more on capital gain amendments this time. Every amendment in this chapter is very important. Okay. So first of all, come to the first amendment. Period of holding. My dear students, while calculating the capital gain, we have to know the capital asset, whether it is long term or short term. How to decide whether the capital asset is long term or short term? Based on the period of holding. Okay, my dear students, generally in before amendment, we have 3 category of assets. We have 3 category of assets. Okay, so for category 1 assets, around 5 assets, around 4 assets were covered in category 1. For these 4 assets, we have to decide whether it is long term or short term based on 12 months period. If it was held for less than or equal to 12 months, long term. Otherwise, it shall be treated as a short term. Otherwise, it shall be treated as a long term. Period of holding is less than or equal to 12 months, a short term capital asset. More than 12 months, long term capital asset. For category 1 assets, we have to consider 12 months period. Have you understood? But in category 2 assets, we have only 2 assets in this category. One is immovable property, that is land, building, both, and unlisted shares. But these 2 assets, we have to consider 24 months to decide whether it is long term or short term. 24 months. If it was held for less than or equal to 24 months, then it shall be treated as a short-term capital asset. If it was held for more than 24 months, it becomes a long-term capital asset. For all other assets not covered in category 1 and category 2, all other assets we have to consider 36 months. All other assets 36 months. Okay. So this is the existing provision, my dear students. This is the old provision, that is before amendment. We have three types of categories of assets. For each category, we have to follow separate period of holding, right? But the amendment is, this is the amended area. Okay. After amendment, this provision was simplified after amendment. Have you understood? So this is also a favorable amendment to the assessee. The table was simplified. Here now we can identify only two categories. Category 1, category 2. 36 months category is not there. Simply says that 36 months was merged into 24 months. We have only two categories. For category 1 assets, to decide whether it is long term or short term, 12 months period to be considered. For all other assets not covered in category 1, we have to consider 24 months. No 36 months period is there. Okay. So I think the provision was simplified. It's a favorable amendment to the assessee. Okay. But my dear students, please be concentrate here. The amendments in capital gain chapter with effect from middle of the year, not from beginning. Therefore, we need to remember old provisions also, need to keep in touch with old provisions also. So please concentrate the heading, old provision, date of transfer before 23/7/2024. You have to follow the old provision. If date of transfer of capital asset on or after 1/4/2024, we have to follow the new provision. Amendment with effect from 23/7/2024. Before that, if you have transferred your capital asset to any other person, then you have to follow the old provision, that is before amendment provision. Three types of categories are there. So that is some extent difficult to you this year, because all capital gain amendments are with effect from middle of the year. Therefore, you need to remember even old provisions also. Don't forget the old provisions. Please keep in touch with old provisions also. So whether old provision or new provision depends on date of transfer of capital asset. If it was transferred before 23/7/2024, you have to calculate whether it is long term or short term based on old provision. If date of transfer on or after 23/7/2024, you have to apply new provision and decide whether it is long term or short term. Have you understood? This is the first amendment in capital gain chapter. Please be concentrate more. Amendment with effect from 23/7/2024. Okay. Next one. Second amendment in this chapter, capital gain chapter, is most important amendment. It's a buyback of shares, section 46A. All these amendments in this chapter are very important. Okay. So buyback of shares. So this time we expect a question from this section 46A. Please be concentrate. Please be prepared at least to one problem relating to this section. Okay. So buyback of shares, company point of view. So this amendment is also with effect from 30th 1/10/2024. Before that, we have to follow a old provision. This is the old provision. This is the new provision. But you need to remember both the provisions because the amendment with effect from 1/10/2024. Okay. First of all, I'll explain the old provision. When the company buyback its own shares, generally shareholders' point of view are required to calculate capital gain. So buyback up to 30th 9/2024. I'll explain old provision and new provision. What the old provision says that company buyback its own shares. Company, there are two parties involved in this, company and shareholder. Company and shareholder. There are two cases. Case 1. In case 1, company is liable to pay tax. Shareholders are exempt from tax. Okay. So in case 2, company is not liable to pay any tax. Shareholders are liable to pay tax. This is the old provision. In old provision, we have two cases. In case 1, company itself is liable to pay at the rate of 23 point. It's nothing but there is a tax rate. Company is liable to pay an additional income tax. Okay. Whenever company is liable to pay, then shareholders not liable to pay any tax, exempt from tax. In case 2, company no need to pay any tax, but shareholders liable to calculate capital gain. Okay. So I show you the old provision. This is the old provision. This is the case 1, case 2. In case 1, company is taxable. Company is liable to pay additional income tax at the rate of 23.296%. 23.296%. Okay. Whenever company is liable to pay additional income tax, shareholders are exempt from tax. Exempt under section 1034A. Shareholders not taxable because exempt in the hands of shareholders under section 1034A. Have you understood? So this is case 1. What is case 1? Please verify it here carefully. Buyback made by domestic company, and buyback asset is shares, whether listed or unlisted shares. Two conditions involved in this case. One is buyback by domestic company, and what the asset buyback? That is shares, whether it is listed or unlisted shares. If these two conditions were satisfied, then case 1 gets attracted. If case 1 gets attracted, then company is liable to pay tax, additional income tax at the rate of 23.296%. Whenever company is liable to pay, shareholders not taxable. If any of these two conditions were not satisfied, if it is not a domestic company, if the asset is not a shares, then case 2 gets attracted. Case 2, what is the treatment? Company not liable to pay any tax to the government, not taxable. Shareholders are liable to calculate capital gain. Exact the treatment is reverse. Okay. So now this question, this is the existing provision before amendment provision. Okay. Of course, this provision will also be applied some period in current previous year because the amendment with effect from middle of the year. Okay. So how this rate was arrived is very important. So this is tax 20% plus surcharge 12%. 2.4. 20% into 12%. Total 22.4 plus cess 4%. Then we'll get 23.296%. Okay. That is the additional income tax rate applicable by company is liable to pay an additional income tax at the rate specified here, 23.296. On which amount this rate will be applied? It was provided in here. 23.296% will be applied on at the time of buyback, whatever the amount distributed to shareholders. Out of that amount, reduce whatever the amount collected from shareholders at the time of issue of those shares. The balance on which you have to apply this rate. Distributed amount at the time of buyback minus amount recovered at the time of issue of those shares to the shareholders. The difference is taxable at the rate of 23.296%. Have you understood? So this is the existing provision before amendment. Two cases are there. Okay. After amendment, this is the after amendment provision with effect from 1/10/2024. Okay. So what is the amendment here is, I'll explain, just wait. After amendment, new provision. After amendment, company, shareholders. Whatever the payment made by the company at the time of buyback, company point of view, no need to pay any tax. Company point of view, no need to pay any tax. at the time of buyback after amendment. Here no different cases applicable here. Here only one case is there, that is company point of view, no taxability will arise at the time of buyback. It's a new provision. But shareholders point of view is very important point. Shareholders point of view have to calculate two heads of income. Most important point here is, that is whatever the amount received by shareholder from company, the shareholder is liable to pay tax on that amount under the head income from other sources as deemed dividend under section 222F. Okay, that should be the important point. So what the point applicable here is, amount received on buyback taxable under the head taxable as deemed profit under the head income from other sources, under the head income from other sources under section 222F. This is the treatment. Whatever the amount received by shareholder at the time of buyback shall be taxable as it is under the head income from other sources, diverted to other sources head of income under a new section, that is 222F in deemed dividend concept. Okay. And one more important point, no deduction of expenses available from this payment. It's a fully taxable. No expenses shall be deductible from this payment. No expenses shall be deductible. From this amount under section 57 under the head income from other sources. This amount is fully taxable, and in addition that the shareholders also be required to calculate capital gain, and shareholders need to calculate capital gain. Shareholders are required to calculate capital gain also by taking the consideration as nil. No consideration is there, because what is the format for capital gain? Consideration minus cost of acquisition. Here no consideration is there, because whatever the amount received by shareholders as a consideration will be shifted to other sources as a deemed dividend. But while calculating the capital gain, so consideration not available. So therefore need to calculate capital gain by taking the consideration as nil. Okay, that should be the important. Therefore the cost is there but consideration is not there. Therefore the resultant capital gain is negative. That it's a loss. That loss can be adjusted against any other capital gain. That should be the calculation. Capital gain by taking, need to calculate capital gain by taking consideration as nil. Okay, that is, we have to use this format for calculating the capital gain. That is, consideration shall be taken as nil minus cost of acquisition is there. The resultant capital gain is negative. Capital loss, whether it is long term or short term, it can be adjusted from any other capital gain. That should be the treatment in the hands of shareholders after amendment. Shareholders point of view need to calculate two heads of incomes. One is other sources, second one is capital gain. But company point of view, no taxability will arise after amendment. Before amendment, we have two cases. In one case, company is also liable to pay tax. In another case, shareholders liable to pay tax. But here is always shareholders liable to pay tax. Company need not pay any tax to the government. Have you understood? This is the amended area in section 46A. This is the after amendment. Have you understood? So next. So this is the amendment, the company point of view. After amendment, no liability to pay any tax to the government. Shareholders point of view, the amount received by shareholder on account of buyback are treated as deemed dividend under section 222F. No expenses shall be deductible. And in addition, that company is liable to calculate capital gain by taking consideration shall be deemed to be nil. Consequently, the cost of acquisition of such shares will becomes the long-term or short-term capital loss, which can be adjusted in the hands of shareholders within the parameters of 70, 71, 74. These are the set of related sections. Inter-source, inter-head, carry-forward sections. So this loss can be adjusted either in inter-source under section 70, inter-head under section 71. If not adjusted, carry-forward facility is also available for this capital loss. This is the amended area. Have you understood? Next, for better understanding this amendment, here there is an example was provided. I'll explain this example also. Just wait. So assessee purchased, shareholder purchased 100 shares in 2000 year at the rate of 40 per share. Total cost is 4,000. Total he was purchased 100 shares. Total 100 shares purchased. Cost is 100 into 40 rupees is equal to 4,000. Okay. Out of that, what happened? Please verify. Out of that, 20 shares bought back is buyback in 2024 at the rate of 60 per share. 60 per share, the company buy back 20 shares at the rate of 60 per share. 50 shares was sold by the shareholder on his on his own at the rate of 70 per share. For this, he obtained a capital gain of 1500 rupees. Okay, out of 100 shares, 20 shares were buyback. 20 shares buyback. 50 shares sold in open market. Okay, so for buyback of 20 shares, what will be the consequence? That should be the amended area. We have to apply the amendment here. So how much rate for which the company buy back these shares? 20 shares buyback bought back for 60 rupees per share. For that, company paid 20 into 60 rupees, 1200 rupees. Shareholders received at the time of buyback 1200 rupees as a consideration. That 1200 to be shifted to other sources side of income. Okay, so for buyback, the shareholders are required to calculate two heads of incomes. One is income from other sources. Second one is capital gain. What was the income from other sources? Whatever the amount received on buyback shall be taxable under the head other sources. Amount received on buyback is equal to is equal to 20 shares into 60 rupees is equal to 1200. This will be taxable as deemed profit. Under the head income from other sources, under section 222F. Okay. So in addition that, the shareholders is required to calculate capital gain also by taking the consideration as nil. So here the consideration is equal to nil. Nil. Minus cost of acquisition is there, but for how much these shares were purchased at the rate of 40 rupees. 40 rupees into 20 shares, buyback shares 20. 20 into 40, 800. 20 into 40 is equal to 800. Therefore, 800 is the loss, capital loss. Have you understood? Okay. So, and one more important point, whatever the loss you obtained here, on sale of further sale of 50 shares sold, for that he earned a capital gain of rupees directly given in the problem. 800 rupees. Cost of acquisition shall becoming a loss, and for that He earned a capital gain of 1500. On sale of 50 shares, he earned a capital gain of 1500. Therefore, this loss can be adjusted against this amount. Then the balance taxable value is only 700, on which he is liable to pay tax to the government. Okay, this is an example, a small example for better understanding the amended provision. Okay, so next one. Okay, my dear students, next one, capital gain tax rates. That's the most important area. The tax rates were changed. Before starting this provision, capital gain tax rates, my dear students. So there is a change in 111A, 112A, 112. Okay, in these three areas, we can find changes, but there is no change in other than 111A. No change here. No change. Okay, so this time we have amendments in tax rates in 111A section as well as 112A as well as 112 also. First of all, I'll explain in section 111A. Okay, first of all, capital gain tax rates. 111A, 111, we have two different capital gains are there, long-term capital gain, short-term capital gain. So both long-term and short-term are having separate tax rates. First, I'll explain the short-term capital gain tax rates. Short-term capital gain. So my dear students, we have two different, one is if section 111A gets attracted. I'll explain when section 111A gets attracted. So that is an existing provision, no change in that. There are some conditions to be satisfied for attracting 111A. Please go and verify in your material. Okay, if section 111A gets attracted, section 111A attracted, the applicable tax rate is, my dear student, very important. Earlier it was 15% tax rate will be applied here. 15%. If date of transfer before 23/7/2024, the rate is 15%. If date of transfer on or after 23/7/2024, the rate increased to 20%. That should be the amendment. It's an unfavorable amendment to the SSA. Before 23/7/2024, flat 15%. On or after 23/7/24, flat 20%. This is the important change in this. Okay, date of transfer depends on which rate is applicable. It purely depends on the date where you transferred your capital asset. Okay, so I'll write here, if date of transfer before 23/7/2024, on or after 23/7/2024. So here the tax rate is at the rate of 15%. Here at the rate of 20%. It's an unfavorable amendment to the SSA. The rates was increased. And this is also with effect from 23/7/24, middle of. You have to remember both the rates. It depends upon date where you transfer. Very important point. Okay, I'll explain when section 111A gets attracted. Just wait. Next, other than 111A. Other than section 111A. normal tax rates. No change in this. Earlier also normal tax rates. Now also normal tax rates. No change. But this is an amended area. This is an amendment. Have you understood? So this is the important change in short-term capital gain relating tax rates. Under section 111A, earlier it was 15%, now it was 20%. So whenever section 111A does not attract it, you can follow the normal tax rates. Okay. Okay. So next one is long-term capital gain tax rates 112, 112A. In these two sections, there is an amendment in Finance Act 2024. Okay. So here is the tax rates applicable under section 112A. 112A. Here also same up to 20. If date of transfer before 23/7/2024, 10% rate. On or after 23/7/24, applicable rate is 12.5%. The rate was increased. Even short-term 111-year rate was also increased from 15% to 20%. I think these are unfavorable amendments to the assessee. Okay. So 112A tax rate, if date of transfer before 23/7/2024, 10% flat. On or after 23/7/2024, 12.5%. And however, this is also an exemption amended area. So from 112A capital gain, this previous year, that is 24/25, you are eligible to claim exemption up to 1,25,000 for entire previous year 24/25. So this exemption is for throughout the year. (2024, 2025). So that should be the important for entire previous year. You have to claim exemption. For example, in 24/25, you have a long-term capital gain under section 112A in aggregate 6 lakhs rupees. Out of that, you have to claim 1,25,000. So per year exemption. The balance is taxable, depends on tax rate applicable, depends on date of transfer. Either 10% or 12.5%, depends on date of transfer. But before taxability, before applicability of tax rate, you have to claim exemption up to 1,25,000. Okay. But earlier previous year, that is in previous year 23/24, it was only 1 lakh. The exemption was increased. For entire financial year, 1,25,000 now. Earlier year 23/24, it was only 1 lakh. This is to some extent favorable to the assessee. Have you understood? So this is 112. 112 capital gain. Earlier is nothing but date of transfer up to 23/7/24, 20%. It was reduced to 12.5%. So I'll explain in a simplified manner long-term capital gain tax rates. Just wait. So this is the short-term capital gain tax rate. Here is an amendment, 20% is the amendment. Now long-term capital gain tax rates. Long-term capital gain, we have two types of tax rates, 112A, section 112A, section 112. Okay, in both the areas, so we have an amendment in Finance Act 2024. 112A. So date of transfer, based on date of transfer. Date of transfer before 23/7/2024, on or after 23/7/2024, 7/24. Okay, before 23/7/2024, the applicable tax rate is at the rate of 10%. Here is at the rate of 12.5%. 12.5% is the amended rate increased, but retrospect with effect from 23/7/2024. Okay, and one more important point, highlighted points here is under 112A section, even if it is a long-term capital asset, even if it is long-term capital gain, no indexation facility under section 112A. It is not an amended provision, so it's an existing provision. Indexation not available here. Indexation not available under section 112A. And one more important point, amended area, that is 112A capital gain is exempt up to 1,50,000, balance only taxable as per the rate specified above. Exempt up to 1.25 lakhs, balance only taxable. At the rates specified above. That is either 10% or 12.5%, depends on a date of transfer. If it is transferred before 23/7/24, you have to apply 10%, on or after 12.5%. But before taxability, before applicability of tax rate, you have to claim exemption, 1,25,000. 1,25,000 is an amended area. For entire financial year, this limit of exemption is available. That should be the important point. Okay. So 1,25,000 is an amended area. The rate was increased to 12.5%. That is also as an amended rate. Next, 112, most important area and some extent confused area. Generally, here also date of transfer. Before 23/7/2024, on or after 23/7/24. Okay, so here also important point, before 23/7/2024, the applicable rate is at the rate of 20%. And one of the important point here, indexation facility available with indexation. Okay, now what the amendment in this area is, if you have transferred the asset on or after 23/7/2024, you have to apply 12.5%. The rate was decreased from 20% to 12.5%. 20% to 12.5%. But however, the indexation facility was removed. Without indexation, you have to calculate capital gain without using indexation facility and pay tax at the rate of 12.5%. Without indexation. That should be the important area. Have you understood? So old rate is depends on date of transfer. If you transferred the capital asset before 23/7/2024, you have to apply 20%, calculate the capital gain with the help of indexation. If it was transferred on or after 23/7/24, apply tax rate 12.5% and don't use the indexation facility. Indexation was removed. For that, they reduced the rate from 20% to 12.5%. That should be the important point. Have you understood? But here is most important point here is grandfathering benefit is available here. grandfathering benefit is available to some selected associates. Grandfathering benefit available to resident individual and resident HUF, subject to some conditions. So this is the most important area in this capital gain amendments. Grandfathering benefit. What is grandfathering benefit? This grandfathering benefit is not available if transfer before 23/7/2024. So this benefit is not available here. Available only if date of transfer on or after 23/7/2024. The grandfathering benefit available here. What is the grandfathering benefit? The grandfathering benefit is generally the benefit provided to old investors. Old investor is nothing but who invested before the amendment, that is before 23/7/2024. That too, the assessee must be resident individual, resident HUF. What is the grandfathering benefit? Even if date of transfer on or after 23/7/2024, they have to pay tax. They have to follow either old rate or new rate, whichever is beneficial to him. An option given to them. So they have to solve the problem in both the options. With indexation, apply tax rate 20%, that is old rate. Without indexation, apply 12.5%, that is tax rate. Then compare the two tax liabilities. Then select which option is beneficial to them. That should be the grandfathering benefit. Grandfathering benefit available only if date of transfer on or after 23/7/2024. That too available only to two persons, resident individual, resident HUF, subject to some other conditions. I give you the conditions. What is grandfathering benefit? First of all, grandfathering benefit is equal to grandfathering benefit. What is grandfathering benefit? They have to calculate the capital gain. They have to calculate capital gain and tax liability as per the old rate. This is the old rate before amendment rate. This is the new rate. This is the new rate. This is the old rate. So they can follow either old rate or new rate, whichever is lower, whichever is beneficial to them. That should be the benefit. If old rate is beneficial, then they can follow the old rate. Even if date of transfer on or after 23/7/2024, they are still eligible to pay tax as per old rates, because tax liability as per old rate is beneficial to them. So this is the favorable provision to the assessee, but this benefit is available only to some selected persons. Who are eligible to grandfathering benefit here is resident individual, resident HUF, subject to some other condition. First of all, the grandfathering benefit is without indexation, with indexation. This is the old rate. With indexation, 20% tax rate, or without indexation, 12.5% tax rate, whichever is beneficial to assessee. Beneficial is nothing but lower. That should be that they can select either old rate or B rate, new rate, whichever is beneficial to them. That is beneficial to assessee. Even if date of transfer on or after 23/7/2024, they have still followed the either old rate or new rate, whichever is beneficial to them, and need to solve the problem in two options. One is with indexation, compute the capital gain and calculate tax at the rate of 20%. Second option, with indexation, compute the capital gain and calculate the tax at the rate of 12.5%, and compare these two taxes and select which option is beneficial to you. That should be the benefit. Have you understood? But this grandfathering benefit is available subject to some other conditions. What are those conditions? Okay, so yeah, grandfathering benefit available to individuals and HUF subject to the following conditions. What are those conditions? These are the conditions important. First condition, assessee must be resident individual, resident HUF. That is, no grandfathering benefit is available if transferor is any other person other than resident individual, resident HUF. These two persons are only eligible to apply the grandfathering benefit. Second one is asset transferred, land or building or both. That is immovable property. This benefit is available only to immovable property. Have you understood? And whether it is residential or commercial, whatever it is, but it must be either land or building or both, immovable property. And the date of acquisition prior to July 23, 24, that is before amendment. Before amendment, it was acquired before amendment. What is the amendment date? 23/7/2024. Therefore, the asset was acquired before the amendment date, that is 23/7/2024. Date of transfer must be on or after 23 July 2024. That is after amendment. Okay, so around 4 conditions are there. If all these 4 conditions were satisfied, then grandfathering benefit is available. Okay, what is grandfathering benefit? Is nothing but this is the grandfathering benefit, 12.5% without indexation. This is the new rate. 20% without indexation. This is the old rate, whichever is lower. Have you understood? So that should be one of the important point. For example, here one thing you should remember: if the resultant amount is loss, then it shall be ignored, not eligible to set off and carry forward. That should be the important point. The provision, above provision, grandfathering benefit is not applicable. So prior to July, purchased, the above provision is not applicable if capital gain arises on transfer of land before or building or both prior to 31st. If the date of transfer before 23/7/2024, the question of grandfathering does not arise. Grandfathering benefit is available. The transfer date must be on or after 23/7/2024. If it was transferred before that date, no grandfathering benefit. You can follow the old rate directly because date of transfer before. Have you understood? Important point. But what is this note? Says that actually, I'll give you example for this. So all these conditions were satisfied by the assessee. All these conditions were satisfied by the assessee. Therefore, the assessee is eligible to claim grandfathering benefit. Mr. X is a resident individual. Resident individual. Of course, the asset was purchased before 23/7. Asset 23/7/2024. Purchased. Transferred on or after. And the asset is an immovable property. Immovable property. Yes, all the conditions were satisfied. Then here grandfathering benefit is available automatically. Okay. So one of the condition, assessee must be resident individual. Yes, the condition was satisfied. Asset must be immovable property, land, building, both. Yes, condition was satisfied. And the date of purchase before 23/7/24. Yes, satisfied. Date of transfer on or after 23/7/24. Yes, this condition was also satisfied. If all these 4 conditions were satisfied, then grandfathering benefit is available. What is grandfathering benefit? You have to calculate the capital gain in 2 options. Which option is beneficial to you can be selected. Have you understood? For example, I'll explain. Option 1, option 2. With indexation. Without indexation. I'll give you a practical example for this. Consideration is equal to consideration is equal to 60 lakhs. 60 lakhs. Minus, in option 1, we have to take indexed cost of acquisition because with indexation. In option 2, we have to take without indexation, that is actual cost to be considered as it is. So in option 1, we have to take indexed cost of acquisition. Indexed cost of acquisition. Option 2, cost of acquisition. For example, let us take an example. The indexed cost of acquisition is 62,70,000. Let us take an example. 62,70,000. So for example, 62 lakhs indexed cost. Cost of acquisition is 45 lakhs. Cost of acquisition 45 lakhs. Indexed cost of acquisition 60. Cost of acquisition 45 lakhs. If it was indexed, then the indexed cost of acquisition is 62 lakhs. So in option 1, which amount to be considered? Indexed cost of acquisition, that is 62 lakhs. In option 2, we have to take only cost of acquisition, that is 45 lakhs. Okay. So now capital gain is equal to, is a long-term capital gain. In option 1, there is a negative result, that is 2 lakhs. Here positive result 15 lakhs. Here tax rate is at the rate of, with indexation, the tax rate is 20%. Old rate. This is the old. This one is at the rate of 12.5%. Okay. So tax rate with indexation 20%, without indexation 12.5, whichever is beneficial. Now calculate the tax. Tax is equal to, here there is no income, the resultant amount is negative, therefore the tax shall be taken as nil. Here the tax rate is 15 lakhs into 12.5%. So 1 lakh 15 lakhs into 12.5%. So and so amount. Right. $1,87,500. So you can add education cess also. Of course, even if education cess was not added, you can decide it which option is beneficial. Which option is beneficial? Better to opt option 1. Option 2 is not beneficial to the assessee because in option 1 the tax liability is nil. In option 2 you have to pay tax 1,87,500. That should be the grandfathering benefit. Have you understood? But the question is, what this note point says that, so if you applied the grandfathering benefit, if any option contains the resultant amount is negative, that loss shall be ignored. That loss will not be eligible for set off from other capital gains. So whatever the loss arise here shall be ignored. Need not adjust that loss against other capital gain, need not carry forward. Ignored, the tax liability is nil, therefore you have to opt option 1, that is with indexation, that is old tax rate. Have you understood? Generally capital loss can be adjusted against another capital gain, but this loss cannot be adjusted. That should be the note point, important note point. Please verify the note point once. If the resultant amount is loss, then it shall be ignored, not eligible to set off and carry forward. Have you understood? This is all about grandfathering benefit. So this is one of the example provided here for grandfathering benefit. For better understanding the grandfathering benefit, the solution was also provided here. Please verify whether conditions were satisfied or not. So XYZ wants to ascertain the tax liability pertaining to the transfer of land, building are given. XYZ individuals. One of the condition was satisfied. Transferred asset is land, building. Condition was satisfied. So now the question is date of acquisition. Yes, it before 23/7/2024. Yes, condition was satisfied. Date of transfer on or after 23/7/24. Condition was satisfied. Here also First condition satisfied, second condition was also satisfied. Purchase date before 23/7/24, transfer date on or after 23/7/24. But here the condition was purchase date condition was satisfied, but transfer date not satisfied. Therefore, grandfathering benefit not applicable to Z. So therefore, Z is followed the old tax regime because date of transfer before 23/7/2024. Therefore, they have to pay tax at the rate of 20% and calculate the capital gain with indexation because transfer date is before amendment. Even grandfathering benefit is available in first two persons X and Y, but not available to Z. That is the main content in this problem. Grandfathering benefit available, not available. So that for X and Y, calculated the income in two options, option 1, option 2. For Y also option 1, option 2, with indexation, without indexation. Z point of view, no grandfathering benefit and date of transfer before 23/7. Therefore, directly you can calculate capital gain with indexation and apply tax rate 20%. Have you understood? Please verify this problem relating to 112. Next. Finally, my dear students, I want to explain when section 111A, 112A gets attracted. My dear students, this is not an amended area, so it's an existing provision, but better to listen carefully. So when section 111A, 112A gets attracted. Okay, so it's an existing provision, not an amendment. Please go and verify in your material. In a simplified manner, I'll explain when these sections get attracted. Okay, so first of all, my dear students, in these two sections, 111A, 112A, the assets are same. Equity shares, units of equity oriented mutual funds, units of business trust. So equity shares, units of equity oriented mutual fund, equity oriented mutual funds, units of business trust. These three assets covered in both section 111A, 112A. If these assets are long-term capital asset, then 111A, 112A gets attracted. If it is short-term, you can apply 111A. That should be the difference. The assets are same in both the sections. So equity shares, units of equity oriented mutual fund, units of business trust, listed equity shares. Okay. So now one more important point here is conditions. Conditions, very important. If these assets were transferred through stock exchange and STT paid, then 111A, 112A gets attracted. Conditions for applicability of 111A, 112A is same, STT paid. So, but when STT shall be payable, that should be the important point. Okay. So, for 111A, condition under section 111A, condition under section 112A. So condition is on transfer of these assets, and at the time of transfer, STT must be paid. Then only 111A gets attracted. Okay, STT paid at the time of transfer. At the time of transfer. That should be the condition to be satisfied for attracting section 111A for above mentioned assets. At the time of transfer of those assets, the STT must be paid. Is nothing but transfer through stock exchange and STT paid. Okay. So then 111A gets attracted. Then 111A related tax rates will be applied. But here is important point. Here also the condition is same, STT paid. But when STT shall be payable is very important. My dear students, please verify. So first two assets, shares, first asset shades, second asset units, third asset units. For shades, STT must be paid not only at the time of transfer but also at the time of purchase. That should be the condition. For shades, STT paid both at the time of purchase and transfer. Okay, this is the condition to be satisfied. Have you understood? And for units is nothing but units of equity oriented mutual fund, units of business trust. For these two assets, STT paid only at the time of transfer. It is sufficient for attracting 112A. STT paid only at the time of transfer. Have you understood? So these are the conditions for attracting 111A, 112A. If 111A gets attracted, then you have to follow 111A tax rate. If 112A gets attracted, then you have to follow 112A tax rate. The tax rate which was already explained. Okay. And one more condition for applying section 112A is date of transfer must be on or after 1/4/2018. Another condition is there. Date of transfer must be date of transfer on or after 1/4/2018. Okay. So these are the conditions to be satisfied for applicability of section 112A. But this date condition not applicable to 111A. Have you understood? So if these conditions were satisfied, then above mentioned sections gets attracted, then respective tax rates will be applied. Of course, in both the sections, the assets are same assets was covered. Listed equity shares, units of equity oriented mutual funds, units of business trust. What about if date of transfer before 1/4/2012? Then we had a section earlier before introduction of 112A. 1033 section is there. 1033 section is there. So at the time of 1033, entire long-term capital gain under section 112A is exempt from tax. The assessee is enjoying full exemption at that time. Have you understood? I give you some information about. So on 1/4/2018, if date of transfer on or after 1/4/2018, then only section 112A gets attracted. Okay. So if date of transfer before this 1/4/2018, then section 1038 gets attracted. Sorry, section 1038. Okay. So what the treatment we had at the time of 1038 is totally exempt from long-term capital gain is totally exempt from tax. Okay, that should be the treatment under section 1038. The assessee is enjoying full exemption under section 1038. Suddenly in 2018, 112A section was introduced. Whenever 112A section was introduced, then automatically exemption withdrawn and exemption is restricted to up to 1 lakh. Balance is taxable. Okay, the treatment, earlier treatment under section 112A is full exemption is not available. It's an unfavorable amendment made in section 112A earlier in 2018. Okay, so earlier treatment is exemption up to 1 lakh. Balance taxable. at the rate of 10%. This is the earlier provision under section 112A. As and when 112A was introduced, then we have to follow, since introduction of section 112A, we have to follow this provision. But in current previous year, there was an amendment. That is amended provision which was already explained in above table. Okay. So now after amendment, in current previous year, what was the amendment? The rate was changed 10% to 12.5% in middle of the year. Have you understood? That should be the provision. That should be the recent amendment. Amendment explained in earlier. Okay, this is the amendment. We have two different rates, 10%, 12.5%, 10%, 12.5%, the rate. And exemption increased to 1.25 lakhs. Exemption up to 1.2 lakhs, 25 lakhs. This is the present provision applicable. Okay, this is the story of section 112A in general. Have you understood? So before introduction of section 112A, we had a section in our act, that is 1038. At the time of 1038, the assessee is enjoying full exemption, 100%. But whenever section 112A was introduced, then the exemption is restricted to 1 lakh initially. Balance is taxable at the rate of 10%. And in current previous year, again the 112A was amended. So the rate was changed as 12.5% whenever the date of transfer on or after 23/7/2024. Exemption increased to 1.25 lakhs. Exemption is throughout the year available, 1.25 lakhs. Have you understood? So that should be the. And one more section is there in capital gain chapter, that is 50AA. That is a small amendment, which is, I think, it's an unimportant amendment. So that amendment was missed in this material. I give you. So amendment in section 50AA. Section 50AA. Section 50AA, what this section says, that this section is applicable only to transfer of applicability. Transfer of specified mutual funds, market linked debentures. Specified mutual funds. Market linked debentures. So these two are existing assets in this section. So no amendment in this. Please go and verify the section in your material. So in addition that in Finance Act 24, another asset was added in this list, that is unlisted bonds. Unlisted bonds or unlisted debentures. Which is transferred or redeemed or matured on or after 23/7/2024. Okay, this is the amended area. This asset was newly added in this section. Earlier 2 assets were covered. Now third asset was also added in this list. Have you understood? So this is the amended area in this 50AA. So in 50AA, treatment is, what is the treatment? There is no amendment in this. The treatment is same as an existing provision. Please go and verify. The treatment, what section 50A says that on transfer of these assets, on transfer of these assets always be treated as short-term capital asset, irrespective of holding period. Therefore, the resultant income is always short-term capital gain or short-term capital. That should be the treatment. Treatment is, there is no amendment in treatment. But the amendment is one more asset was added in this list. That should be. That too, amendment with effect from 23/7/24. Before that date, this asset was not covered in this list. On or after, if it was transferred on or after 23/7/24, then you have to follow 50AA for this asset also. Okay, treatment here is these assets always be treated as short-term capital asset. Hence, the resultant income is always short-term. No amendment in treatment point of view. The third asset was added in this list. That should be the amendment in 50AA. Have you understood? Okay. So, end of the amendments in capital gain chapter. Please be concentrate, my dear students. Most valuable amendments are there in capital gain chapter. Every amendment is very important. Mainly tax rates, 111A, 112A, 112. In these three areas, important amendments are there. Okay. So next chapter, other sources. My dear students, in other sources, we have two amendments. All two amendments are very easy. The first amendment is 56 subsection 2 class 7B. This section was removed. So happy. So if you had prepared already for last attempt, so for January 2025 attempt, please forget it and ignore it. No need to prepare again for upcoming examination. Okay. So 56 subsection 2 class 7B. It's applicable to closely held company. Issue of shares at premium exceeding the fair market value. The excess of fair market value shall be taxable under the head other sources. That should be the content in this section. Now this section no more in existence in the act. Therefore, no need to prepare again. If already prepared for last attempt, just forget it. Okay. Second one. My dear student, this one is important amendment at this time. Family pension. Family pension taxable under the head other sources. No doubt family pension, because there is no relationship of employer and employee between employer and family members. Whenever the employee was deceased, the relationship remains closed. Then whatever the pension received by family members shall be shifted to income from other sources. But important point here is, in other sources head, there is a deduction from family pension under section 57. Deduction from family pension. What is the deduction? Earlier, before amendment, 1/3 or 15,000, whichever is lower. In both the tax regime, default as well as optional tax regime. Default as well as optional tax regime, deduction is 1/3 or 15,000, whichever is lower. If you have received 60,000 pension, family pension, 1/3 is nothing but 20,000. 20,000 or 15,000, whichever is lower. 15,000 deduction is available. Balance 45 taxable. This is the deduction earlier before amendment. There is no difference between default and optional tax regime. For both, the deduction is 1/3 or 15,000, whichever is. Now the amendment is, after amendment, what was the change made by the under default tax regime, just like a standard deduction model. So here also under default tax regime, the deduction increased to 25%. Under optional tax regime, 15,000 will continue as it is. No amendment in optional tax regime. Amendment only in default tax. This is the amended area. So now what is the amendment from family pension? Under default tax regime, 1/3 or 25,000, whichever is lower. Under optional tax regime, 1/3 or 15,000, whichever is lower. Have you understood? Two simple amendment. Okay. End of other sources. Only two amendments. Second one is very important. First section is totally removed. Okay. Next. We'll go to the next chapter, set off and carry forward. Set off and carry forward. So, my dear students, here only one amendment we can find, that is house property laws. House property laws, if not adjusted in intersource, that is, if not adjusted in same source, that is house property income, then it can be adjusted against other heads up to 2 lakhs. If not adjusted in other head also, then it shall be carried forward to subsequent year. But here is house property loss. What is the treatment? That too, amendment made here under default tax regime only. Under default tax regime. Under default tax regime, after amendment, house property loss, if not intersource adjustment available, if not adjusted in intersource. If not adjusted in intersource, then balance loss to be ignored. No interhead facility, no carry forward facility. Complete ignored the remaining loss. Adjust only to the extent of availability of same income from same head. If not adjusted in same head of income, the balance loss to be ignored. That is the amended provision here. Under default tax regime. In optional tax regime, it can be adjusted from interhead also up to 2 lakhs. If not adjusted, carry forward facility is also available under optional tax regime. Have you understood? I give you under optional tax regime. Optional regime. Intersource available, interhead available up to 2 lakhs. Carry forward is also available, 8 years. But here the amendment is only default tax regime. What is the amendment? This is the amended point. After amendment in default tax regime, intersource adjustment is only to be made. If not adjusted, the balance loss to be ignored. So interhead not available, carry forward also not available. Before amendment, intersource available, interhead not available, carry forward available. Now carry forward facility is also not available. That should be the amendment. Have you understood? Single amendment in this chapter, that too important amendment. Please be prepared. I expect a point relating to this in exam. Okay. Next, deductions. My dear students, we can find only one change in this section, that is 80 CCD NPS pension plan, central government pension plan. Central government pension plan. For salaried employees, I'll give you, just wait. Central government pension plan. CCD. Okay. So for salaried employees, generally this deduction is available to both salaried employees as well as self-employees also. Okay. No change in salaried self-employees. Only salaried employees point of view, there is an amendment. This deduction is available to not only to salaried employees, but also to self-employees. Salaried employees. Self-employees. Okay. Salaried employees, generally this deduction is available for both employer contribution as well as employee contribution. Employer contribution, employee contribution. Okay. Generally, benefits are available only to employee contribution. Chapter 6 is available generally employee contributions only. But this is unique benefit in this section is employer contribution is also eligible for deduction. self contribution. Here only one contribution is there, that is self contribution. But deduction is available subject to some limits. What is the limit applicable here? First of all, employed contribution. Employed contribution eligible under section 80 CCD 2. So the limit is, if the employer is a government, being a government, if you are employed being government, employer being government, either central government or state government, maximum deduction cannot exceed 14% of salary, limit up to 14% of salary. That is actual contribution or 14% of salary, whichever is lower is eligible for deduction. Have you understood? But here is, if employed being any other person, employed being any other person, here important point, deduction here also limit is under optional tax regime up to 10% of salary. Under default tax regime, increase it to 14%. This point is the amended area. Under optional regime, the limit is up to 10% of salary. Default tax regime, up to 14% of salary. %, 14%. This is the amended area. What the amendment here is, earlier here also, in default tax regime also, we have to claim 10% only for both optional and default. But default tax regime, the deduction increased to, the limit increased to 14%. This is the amended area. So if employed being a government, 14% for both the tax regimes. There is no amendment here, both regimes. Have you understood? But if you are employed being any other person other than government, then you have to follow two limits. If you want to solve the problem under optional tax regime, the maximum limit is 10% of salary. If it is under default tax regime, the limit is 14%. Have you understood? So employee contribution, 10% of salary, irrespective whether he is government or private. Every employee, no change in this. Change is only employed contribution, that to increase it to 14%. Except that rest of the presentation is same existing. So limit up to 10% of salary. For every employee. Okay. So next, self contribution for self employees up to 20% of gross total income. No amendment here. Okay. So this is the present. This is employee contribution 80 CCD 1. Here also 80 CCD 1. This is the amended area, 80 CCD section. The limit increased to 14% from 10%. That too in employed being any other person other than government. That should be the amended area. Only one amendment. This is the amended area. That too in default tax regime, the increase to 14%. Okay. My dear students, Next chapter, TDS. My dear students, this time around 11 amendments, 10 to 11 amendments are there in TDS chapter. So more amendments. But however, out of that, 4 to 5 amendments are important to you. You need to prepare 4 to 5 amendments. I give you the important amendments in this list. Okay. So don't be concentrate every amendment in this chapter. Some advanced provisions related amendments are there. You need not prepare them. Okay. I give you the important amendments in this. So first of all, how many number of amendments are there in this chapter? The serial numbers 1, 2, 3. 5. Total 11 amendments are there in TDS chapter. Okay. So out of that, only some of the amendments are very important. Please keep in touch with those amendments. First amendment is very important. First amendment important. Compulsory, you need to prepare that. The tax rates were reduced from 5% to 2% in 5 sections. This amendment is too simple. In these sections, 194DA, 194G, 194H, 194IB, 194M, 194O. In these 5 sections, the rates of TDS reduced from 5% to 2%. Earlier it was 5%, now 2%. But the amendment with effect from 1/10/2024. Up to 30th 24, you need to follow old rate. So from 1/10/2024, you have to apply the new rate. That should be the easiest amendment in this chapter, but important, because this amendment made in around 5 sections: 194DA, G, H, IB, M, and O. In all these sections, the rate was reduced from 5% to 2%. That too from 1/10/2024. Easiest amendment and important amendment. Okay, next. And my dear student, this is not required to you because this section was removed. And of course, this section not there in our syllabus also. Therefore, please be ignored. Next. This is the most important amendment this time in TDS chapter. 194 IA. Most important amendment. What is that amendment? Please verify the paragraph once. Generally, 194 IA, what is the transaction covered in 194 IA? Consideration for transfer of immovable property. Consideration for transfer of immovable property if the value or stamp duty value exceed 50 lakhs. 50 lakhs is the threshold limit. Exceed 50 lakhs, then subject to TDS. Of course, agricultural land is an exception to that section. Please go and verify entire section in your material. But I'll explain only amended area. Okay. So 194 IA, this time important, this one is important. Okay. Consideration for transfer of immovable property. Threshold limit is 50 lakhs. If it exceeds 50 lakhs, then TDS shall be made. Okay. But the question is here, important area, where there is more than one transferor or transferee in respect of any movable property, then consideration for calculating the threshold limit shall be aggregate of the amount paid or payable by all transferors to the transferor, all transferees to the transferor, all transferors to the transferee of such immovable property to be considered for calculating the threshold limit. This is the amended, this provision was added in that section. Have you understood? So what is the amendment exactly? I'll explain. Generally, what is the threshold limit? Generally, consideration for transfer of immovable property. X transfer an immovable property to Y. Consideration is 60 lakhs. Yes. Compulsory TDS provisions applicable under section 194 IA. Applicable. Who is liable to make TDS in this? Payer is liable. Who is the payer? X is the seller. Y is the buyer. Generally, buyer is required to make TDS under section 194 IA because buyer is the payer. Okay. But what the amendment made in this? For example, X transfer, an immovable property is there. Immovable property is there. Having two joint owners, joint owners, Mr. X and Y. So jointly, this property was transferred to Mr. R. Mr. R for 80 lakhs. The consideration paid by R shared by X and Y as 40 lakhs received by X, 40 lakhs received by Y. Out of 80 lakhs, entire consideration was shared between X and Y as the equivalent ratio, that is 40 lakhs, 40 lakhs. They argued that, they might be argued that there is no specific provision before this amendment in that section. So here is X and Y argued that the consideration received by X himself does not exceed 50 lakhs. What is the threshold limit in that section? 50 lakhs. Consideration received by Y himself does not exceed 50 lakhs. Just they received 40 lakhs share. They argued that this payment is not subject to TDS because consideration, individual consideration does not exceed 40 lakhs. That is what the provision says, that if consideration payable to, aggregate consideration payable to, please verify the sentence once. Aggregate amount paid or payable by all the transferees to transferor. All the transferees to transferor, or all the transferor to transferee. Aggregate amount to be considered. Have you understood? So, but here, how much amount paid by Mr. R? Yes, 80 lakhs was paid. But it was shared by X and Y, 40 lakhs each. Even though if it was received 40 lakhs each, while making TDS, aggregate consideration to be considered. So TDS must be applicable on this amount. Compulsory TDS shall be made. Earlier, this clarity is not there in that section. Some persons, some associates might be argued that to get a loophole, to avoid the escape from TDS provisions. That's why the department provides clarity in that area. Okay, so that should be the important point. This provision is applicable in reverse also, vice versa also. That should be the another sentence. For example, I give you here, immovable property is there. Immovable property is there. Here, buyer, Mr. R, seller, X and Y. Okay, two sellers, single buyer. Therefore, whatever the amount paid by the buyer, so in aggregate for both X and Y to be considered for calculating the threshold limit and subject to TDS under section 194 IA compulsory. Okay, but here is the explanation will be reversed. That is, two buyers is nothing but A, B, buyers. Mr. S, seller. So, immovable property. The immovable property of Mr. S, seller, purchased by A and B jointly. And for that, the consideration is 80 lakhs for 80 lakhs. But the payment was made by both the buyers because they purchased the asset jointly. X paid 40 lakhs. A paid 40 lakhs, B paid 40 lakhs. Generally, who is liable to make TDS? buyer is liable. Here the buyers, two buyers are there in this example. They purchased the asset jointly. For that they paid, each buyer paid 40 lakhs only. Okay. So they argued that here also the argument is same. The individual consideration does not, individual payment does not exceed 50 lakhs. Therefore, not required to make any TDS. That should be the argument made by the assessees. But here also there is a clarity given in that section. That is, here also aggregate payment to be considered. Aggregate payments made by the buyer is 80 lakhs. Therefore, both the parties are required to make TDS under section 194 IA. That should be the important point. Either multiple sellers or multiple buyers are there on transfer of immovable property, then aggregate payment to be considered. Individual consideration not to be considered. In aggregate to be considered. In aggregate, if it exceeds 50 lakhs, then subject to TDS. Okay, whenever multiple transferors, multiple transferees were involved for purchase of immovable property or sale of immovable property, then aggregate consideration to be considered for deducting tax under section 194. Okay, that should be the important amendment. That is aggregate. Important word here is aggregate of amount. Okay, so when this provision gets attracted, more than one transferor or more than one transferee. Whenever more than one transferor involved, more than one transferee involved. In these two cases, aggregate consideration to be considered to decide whether it is subject to TDS or not. Okay. Okay. So, my dear students, first amendment is very important in TDS. Important amendment, this one. And which was already explained. And this one is also very important. So many of amendments are there in TDS. You have to concentrate more on 4 to 5 amendments. So I'll explain important amendments. So point number 7 is very important. Point number 1 is very important. The rates were changed in so many of sections, reduced. Okay, I'll select some more points. So next one is fourth one important. Fourth one, 194. 194. So my dear student, it was already discussed in capital gain buyback related point. This is connected to buyback in 46A in capital gain chapter. Okay, so buyback, what happened at the time of buyback? Whatever the amount received by shareholders at the time of buyback will be treated as deemed dividend under section 222F. A new section was introduced in other sources head, that is 222F. Amount received by shareholder at the time of buyback will be treated as a deemed dividend. Whenever the payment will be treated as a deemed dividend, then the company is liable to make TDS under section 194. So 194 was also amended. A deemed dividend under section 222F was included in this section. Therefore, deemed dividend under section 222F is also subject to TDS under section 194, because 194 deals with TDS on dividends, including deemed dividends. That should be the point. Interconnected point with the 46A in capital gain chapter. So companies will now be amended to withhold tax at source on buyback proceeds at the rate 10%, TDS rate under section 194. So per resident individual, 20% if payment made to non-resident individual. This is the TDS rate. 1%, 10% if payment made to resident. Shareholder is a resident, 10% TDS rate. If shareholder is a non-resident, then 20% TDS rate gets set. Please be remember 10% rate. because non-resident TDS sections not there in your syllabus. So 10% is the TDS rate. This point was connected with section 46A buyback. Whatever the payment received by shareholder at the time of buyback will be treated as a deemed dividend. Whenever the payment shall be treated as a deemed dividend, then that payment is subject to TDS under section 194. That should, but important. Okay. Next, 192. It's an unimportant point. So 192, what was the amendment? And one more important point, my dear students. 194 effective date. The date was missed in 194. Effective date of 194 section 110/2024 with effect from this amendment with effect from 110/2024. At this date with effect from 110/2024. With effect from 110/2024, this amendment. So one of the important amendment this time in TDS chapter. In addition that first one, seventh one and fourth one, these three are very important. Okay. So next one, 192. It's an unimportant amendment. That is what exactly the change was made in this section is. This amendment is also with effect from 110/2024. Amendment is allowing deductor employed to take TCS into account while calculating the TDS liability under section 192. 192 is nothing but TDS on salary payment shall be made by the employer. My dear students, so employer is required to make TDS under section 192 from salary payment if it exceed basic exemption limit. But while making TDS under section 192, here the amendment says that if employee submitted the details of TCS, if any, TCS, if employee having any TCS and the details of TCS was submitted to his employer, then employer while making TDS under section 192, whatever the details submitted by the employee relating to TCS shall be considered and deducted. The balance only to be deducted by the employer as TDS under section 192. That should be the amendment. A sentence was added. So if employee is having any TCS relating to his payments, the TCS details shall be submitted to his employer. Based on that information, the employer deduct such TCS amount. Balance is only deducted by employer. For example, after calculating the TDS amount by the employer, TDS on salary payment. At the time of calculation of TDS amount, so employer calculated TDS amount, for example, 2,30,000. Employee submitted some details relating to TCS, relating to his incomes. Then such TCS amount shall be deducted from this TCS. For example, 50,000 details submitted. Therefore, employer is required to make TDS only 1,80,000. Earlier, this provision is not there in that section. Now it was added newly. TCS is also shall be deductible while making the TDS under section 192. That should be the important point. Please go and verify. I think it's an unimportant amendment. So please read it once. Allowing deductor. Deductor is nothing but employer. Allowing deductor to take TCS into account. To take TCS into account is nothing but deduct such TCS amount. So while calculating the TDS liability under section 192. Okay. So it's a procedural aspect. In my opinion, it's an unimportant, maybe useful for 1 mark, but please read it as it is. That sentence itself is sufficient. Earlier, TCS shall not be deductible while calculating the TDS under section 192. Now that facility is available, but based on the details submitted by the employee. Proofs must be submitted by the employee to the employer. Then only the employer consider those details and submitted by the employee and deducted the same. Okay, enough. Next, 193. This is also effective date 1/10/2024. So, some extent important this one is. 193, that is interest on securities subject to TDS under this section. In that, a new sentence was added, a new securities was added in that section, that is floating rate savings bonds. Now, floating rates savings bonds are also, the interest on floating rates savings bonds is also subject to TDS. This was added in section 193. Okay, interest payable on floating rate savings bonds, now subject to TDS, but there is a threshold limit, that is 10,000. Threshold limit here is 10,000, exceed 10,000. Generally in 193, we can find 5,000 threshold limit. Have you understood? But for this payment, the threshold limit is 10,000. 10,000 threshold limit is there for this payment. Okay. Earlier also 10,000 threshold limit applicable to some other bonds, 8% savings bonds, 7.75% savings bonds. In that list, newly added one more point, that is floating rate savings bonds issued in 2020. The interest is also subject to TDS, but it exceeds 10,000. If it does not exceed 10,000, no need to make any TDS. If it exceeds 10,000, entire payment is subject to TDS under section 193. Okay, please be verified carefully. Some extent important. First one, fourth one, seventh one is most important amendments. Okay, next. 194F removed. 194C contract payment. Generally 194C is applicable to contract payment. Contract payment is subject to TDS. Any type of contract, including supply of labor, including subcontract also. But there is a definition of works contract. Works contract subject to TDS under section 194C. But there is a definition of works contract. But in that definition, earlier, sums covered in 194J not covered in that, not specifically excluded from that definition. Therefore, some assessees misuse this section. So there is a connection of 192 and 194J, because in 192 the TDS rate is 1% or 2%, but in 194J 10%. For technical fee 10%, for professional fee for technical fee 2%, for professional fee 10%. There is a variation between tax TDS rates in 194C and 194J. Okay, so some assessees are wrongly interpret the payments covered in 194G as 194C, so that the works definition was revised and specifically excluded that whatever the payments covered in section 194J are not be treated as a work, therefore not subject to TDS under this section. If payment was covered in 194J, then it will not be covered in 194C. Therefore, never apply 194C for that payment, because it was already covered in 194J. So the definition was changed and specifically excluded. So please verify the sentence. When with effect from, this is also effective date 1/10/2020. It is clarified that any sum covered under the provisions of 194J, fee for professional services and technical services, does not constitute work for the purpose of 194C. Not be treated as a work. Therefore, not subject to TDS under section 194C. If it was covered in section 194J, the definition was changed and excluded the sums covered in section 194J from 194C. Okay, so that should be the next. This is also some extent important. Please read it once at least. Okay, next. 197 and 206C9. My dear student, these two sections are less rate of TDS, no TDS certificates. certificate for lower deduction or lower collection. Lower deduction or lower collection of lower collection certificates. 197 is the lower deduction certificate. 206C9 is the lower collection certificate. So if you apply to assessing officer and obtain a certificate from assessing officer for no deduction of tax or less rate of deduction of tax, it's a favorable point to the assessee. Have you understood? Generally, the TDS rate in a particular section is 5%. But the payee is having an option to apply to assessing officer for obtaining this certificate. What the provision says that, so the fact will be explained to assessing officer through application, and if assessing officer was satisfied, then he will give a certificate to you. That certificate contains no deduction or less rate of deduction. Actual rate is 5%. Okay, so the assessing officer gives a permission through issue of certificate. The certificate contains either no deduction or less rate of. Immediately, whatever the permission given by the assessing officer will be followed by payer. The payer need to deduct only TDS at the rate specified in that certificate. In that certificate, the assessing officer mentioned only 2%. Then it is sufficient to make 2% instead of 5%. If no deduction was mentioned in that certificate, then payer is not required to make any TDS. This is the story of 197 and 206C9. Lower deduction, lower collection. Lower collection is nothing but TCS related section. Lower deduction is nothing but TDS related section. In these two sections, the assessee is enjoying some TDS benefits. Okay, but the question is, these sections are applicable only to some selected sections. In those sections only, the assessee can obtain lower deduction certificate, lower collection certificate from the assessing officer. But in those sections, a new section was added. So in lower deduction point of view, 197, 194Q also added in 190 lower deduction certificate. So for lower collection, 206C1H was added. So now the assessee can also obtain lower deduction certificate in section 194Q also. Earlier that facility was not available to 194Q. And now the assessee is also eligible to obtain lower collection certificate in TCS section 206C1H also. Earlier that facility is not available. Have you understood? So the lower deduction facility certificate facility was extended to these sections also. Lower deduction, lower collection. So have you understood? That should be the important point. Next. So maybe some extent important. Please read it once at least. 147 amendments are most important. Please be concentrate more. Okay. Next. This is the TCS related section. TCS with effect from 1/10/2000. Here also there is a date with effect from 1/10/2024. Of course, in all the amendments in TDS with effect from 1/10/2024, except 3 amendments. Out of that, 2 amendments with effect from 1st January 25. 2 amendments with effect from 1st January 2025. Rest of the amendments from 1/10/2024. Okay. So next one. It's a TCS section. TCS section 206C1F, sale of motor vehicle. Sale of motor vehicle subject to TCS under section 206C1F at the rate of 1% if value exceeds 10 lakhs. 10 lakhs is the threshold limit. Earlier, this section was applicable only to sale of motor vehicle, but this section was open for other luxury goods also. If value exceeds 10 lakhs, then they are also subject to TDS under this section. Okay, this section was expanded to some other goods also. But what are the goods newly added in this? Not specified by the government at present. Only a sentence was added. This section may expand to, as may be notified by the central government in this behalf. any other goods of value exceeding 10 lakhs also subject to TDS under this section, notified by the central government. Presently, no goods was notified by the central government. Just the sentence was added in that section 206C1F. Presently, sale of motor vehicles are only covered in that section. The section was expanded now. Any other luxury goods, any other goods, if value exceed 10 lakhs, notified by the central government, those goods also subject to TDS under this section. So at present, no goods were notified by the central government. Maybe in future, the government may notify some goods. Therefore, automatically those goods will be covered in this section. We expect an amendment in future also in this section. As and when government wants, the government notified some goods. Automatically, those goods will be added in this section. So then subject to TCS. Okay, at present, no goods notified by the government. Just the sentence was added. Any other goods value exceed 10 lakhs subject to TCS notified by the government, central government. Next, my dear students, next amendment, this is the amendment effective date is 1/1/2025. 1/1/2025, not 1/10/2024. 1/1/2025. So the amendment effective date here is, here what was the amendment here is? So this amendment effective date is 1/1/2025. Please remember carefully. So next, this one is also some extent important. Please verify once. Next, 206C4. It's an unimportant amendment. Last one with effect from 1/4/2025. That is from next year. So you need not prepare this section. You can ignore this completely. Now, it will be applicable to next financial year. And 206C4. This will be applicable from 206C with effect from 1/1/2025. Yeah. 1st January 2025 effective date for this. It's an unimportant amendment. That is, generally this is the clubbing provision 64(1)(a). The TCS of minor children shall be allowed as a credit to parents. That should be the point added in this point. In this section, TCS relating to minor's income will be allowed to parents as a credit. The parents are eligible to claim credit of such TCS collected from the income of the minor children, but subject to a condition: only the income was clubbed in the hands of parents. Then only the TCS will be transferred to parents. If income was not clubbed in the hands of parents, then no TCS credit available to parents. That should be the point. So ensure that this provision is minor. TCS of the minor children only be allowed when the income of the minor is being clubbed with the parent as per section 64(1)(a). That should be the amended sentence. Okay, 206C4. It's an unimportant amendment. TCS credit can be claimed by the parents only when the income will be clubbed in the hands of parents. If clubbing provision does not attract it, then TCS also not to be transferred. These are the amendments in TDS TCS. Okay. Next, return of income. We have only one amendment in this. My dear student, earlier 139 in 139 section, compulsory quoting of Aadhaar number is mandatory while making an application for PAN or income tax return filing. In these two cases, compulsory you have to quote your Aadhaar number. If Aadhaar number is not there, then at least you can quote the enrollment ID of the Aadhaar number also. Enrollment ID. Whenever you apply it for Aadhaar number, they will be allotted a number. That number is called as enrollment ID. That number can also be quoted instead of Aadhaar number. That should be the facility available earlier. Now, quoting of enrollment ID facility was removed. Have you understood? Please verify it. The provision permitting the quoting of Aadhaar number, Aadhaar enrollment ID in the application form for PAN allotment or submission of income tax return was introduced in 2017. This is the old provision. 2017, what was the provision introduced? While making application for PAN, while filing the income tax return, compulsory you will quote the Aadhaar number. If Aadhaar number is not there, at least the enrollment ID can also be quoted. But here the amendment is second paragraph. Since then, based on the publicly available data, Aadhaar coverage has expanded. So, encompassing most of the Indians population, thus discontinue. This is the amendment. Now, that facility is not available. What the facility? Quoting of enrollment ID is not discontinuing the option to quote the enrollment ID from the Aadhaar application form. To prevent duplication and misuse of PAN numbers. That is the objective. To prevent duplication and misuse of PAN numbers, so that the government decided that now never accept the enrollment ID of Aadhaar. Compulsory you have to quote Aadhaar number. Discontinuing the option to quote the enrollment ID from the Aadhaar application. Okay. Compulsory you have to quote the Aadhaar number. This is the procedural aspect, may be useful for 1 mark, but please verify it once. Only one amendment in this. Okay, next. Lastly, exemptions. Exemptions, we have two exemptions. First one is unimportant, second one important. It was already discussed in buyback. What the buyback old provision? Generally in buyback, we have two options, old before amendment. So in case 1, company is liable to pay additional income. Please go and verify the buyback amendment. Before amendment table. Before amendment table, what the provision says that? What the provision says that? So, case 1, company is buyback made by shares listed or unlisted by domestic company. Company is liable to pay an additional income tax. Shareholders are exempt under section 1034. But after amendment, what happened? After amendment, whenever the buyback made, whatever the amount received by shareholders will be liable to pay tax. Company is not taxable. Company never pay any tax after amendment. Always the shareholders are liable. Therefore, 1034 exemption available earlier before amendment now removed whenever the buyback amendment was made. So, there is no taxability to the company. Taxability will arise only to shareholders. Therefore, 1034 section was removed. 1034 exemption with effect from 1/10/2024, because buyback also amended date, prospective date, that is any amount received in respect of any buyback of shares by shareholder will not be exempt from tax. Now 1034 exemption, 1034A exemption not available. Shareholders are not eligible for exemption. So is nothing but buyback related point. Please go and verify the buyback, that too before amendment buyback. Before amendment, this section is there. After amendment, this section related exemption not available. Okay, this is interconnected with buyback related provision. 1034A, sorry. So next one, 1015. It's an unimportant section. Please be verify it once. It's an exempted, newly inserted exemption. Insertion of 1015B, new section. Unimportant. I think it's not in your syllabus also. Need not prepare. So what the exemption here is, any income of foreign company. The associate must be a foreign company. The income name is lease rent. Received a lease rent relating to cruise ship shall be exempt from tax, subject to some conditions. Okay. So who is eligible for exemption? Indian company. Sorry, foreign company. Foreign company is eligible for exemption. What is the income? Lease rental relating to cruise ship is exempt from tax, subject to following conditions. Condition number 1 is such income received from a specified company which operates such ship in India. Okay, the ship who has taken on lease must be operated in India. Okay, so the second one is such foreign company, that is associate, and the specified company must be subsidiary of the same holding company. That should be the second condition. And this exemption is available so up to 1/4/2030. There is a limit for exemption. After that, we'll expect an amendment in this area. Okay, so have you understood? Finally, here HASSI is foreign company. Income received lease rent of cruise ship from other company. And both the companies must be subsidiary of same company. This is another condition. And foreign company point of view, such lease rent is exempt from tax. Okay, and one more condition is there. The other company who taken the ship as lease must be operated in India. The ship must be operating in India. These are the conditions. Have you understood? I think it's an out of syllabus section. You need not prepare. So my dear students, these are the amendments. So made by the made in 2024 Finance Act. Hope you are understood well. So my dear students, all the best to all of you. Thank you.